I want to introduce the next panel that we have here. It's the leadership role of the GCC in global finance. This is a redo, I guess, of a slightly longer conference that Professor Reena Aggarwal put on back in the spring in Dubai, which was fantastic and extremely well attended. We had several people that were there, and the information talking about the GCC's role in capital outflows, the GCC's role in lending across the world, and its impact on finance and society is absolutely fantastic and stunning. And she has brought together some of her colleagues and close friends from across the region to offer some different perspectives. So I'll turn it over to Professor Aggarwal. You might know her. She's a professor of finance in the McDonough School of Business, was interim dean in the business school for several years, and is now the director of the Center for Financial Markets and Policy. Did I get that right? Perfect. And a noted expert and extremely well connected in the region and the world. So, Professor Aggarwal.
Thank you, Charles, and good morning. Thank you for joining us today. On behalf of Georgetown University and the Georgetown Center for Financial Markets and Policy, we are delighted to put this panel together with an extremely good group of panelists here. So we'll make sure that there's plenty of time for a discussion with the audience and a Q&A. So we have Johannes Mongarandi. Johannes is the chief economist at Qatar National Bank. And John Vitalo, most of you know, John is a CEO for Barclays for the MENA region. And Hossein Radwan. Hossein is senior partner at Abraj Capital, one of the very well-known private equity firms in the region. And he brings in the Saudi perspective to this panel. And Kareem Soul. Kareem is the founder of, one of the co-founders of Gulf Capital. Again, a very, very well-known private equity firm in the region. For us professors, it is such an honor to have a panel like this, where you have your former students and you're learning from your former students. There's nothing more satisfying than that. So it's absolutely wonderful to have former students here and to have former students in the audience. So the Georgetown Center for Financial Markets and Policy, our objective is really to provide thought leadership for global finance. After the crisis of 2008, there was a real leadership void in the financial sector. The CEOs and top executives in the private sector had lost a lot of credibility, and they did not want to speak up. They wanted to keep a low profile. And policymakers in Washington were very busy with rulemaking, taking care of yesterday, the problems that had happened. And we really felt that Georgetown had an important role to play and fill this leadership void. That's how the Georgetown Center for Financial Markets and Policy emerged. And it's been quite amazing. In just a very short time period, literally 3 years, we've become the go-to place. We have the power to convene academics, policymakers, and the private sector, bring them together to have an important conversation about the critical issues that need to be resolved there. And as Georgetown University, we are not advocacy group of any kind. We are nonpartisan, and that's why people are interested in our views. And we bring academic rigor to the discussion. And I think that's why we become the go-to place for important discussions about global finance. Just to give an example, obviously we, Georgetown, are in the business of educating students. But we have a much bigger responsibility to society, I feel. And so some of the ways in which we are meeting this obligation to society is the center organizes congressional policy briefing series on Capitol Hill every month. The idea is to educate senior staffers and help them with issues that they're dealing with. And the senior staffers will tell me that we get a lot of information. The problem is the information that we're getting, people they have one angle or another. They're coming to us because they want something. And when you guys come in, we are not intimidated to ask questions. When you guys come in, We know you're going to tell us the pros and cons and provide a balanced picture. So I think that's our role. Just a couple of weeks ago, we did a big event in New York on the hot topic of shareholder activism, too little or too much. You've seen in the news everything from activists going after Apple computers to Microsoft to Dell. So that's become a very hot issue. And again, because we, Georgetown, are not advocating one position or another, we can really we brought in activists, we brought in the SEC commissioners, we brought in other investors, and we brought in academic rigor to it and had a really good conversation, completely sold out event. We had tons of people in the overflow area. So that's our responsibility. Whatever the critical issues of the day are, let us address them. Let's get the right parties at the table. And I'm just delighted that there are so many people here who are supporting the center in so many different ways. And Georgetown is global, so we don't think, and financial markets are certainly global, so we can't think of US financial markets or UK financial markets or Gulf region financial markets. It's global financial markets. Money can flow very easily in and out, so we're definitely thinking in terms of global finance. And this has been a tremendous opportunity for our students also. The students who work at the center, the students who are exposed to the discussions, the dialogues that the center is hosting, that's unique. That's unique to Georgetown, right? Everybody is trying to do global finance. Everybody is trying to do some policy work. But the uniqueness for Georgetown, I think, is of a portfolio approach. We are the ones based in Washington, D.C. We are the ones who've always been global. And brick and mortar is one way of being global, but there are so many other ways of being global. And so many of our students do study exchange programs. Our faculty are involved in global issues in terms of research. So the center is really serving many different purposes. And we're delighted that the center could host this panel today and have just a terrific group of panelists here. So but I started studying emerging markets long before emerging markets became sort of the buzzword. And I've seen everything from, and I'm sure a lot of you have, being called emerging markets, less developed countries, developing countries, all kinds of names were given. I really think I want to call them emerging powers. Okay? In today's world, it's not just about that they're emerging markets, they're really becoming emerging powers. And so it's extremely important that we pay attention. And I've got to say, it's because of John and Kareem that I've become very interested in the Gulf region. My conversations with them have led me to keep coming back to the region and work on the region. I'm working on an OECD project that deals with demutualization of exchanges in the region. And right now, there's only one exchange in the region that's listed on an exchange. But I think I can easily forecast that in the next 5 years, there'll be many more that'll be demutualized exchanges. And demutualization is about exchanges were either owned by governments or they were owned by members, like the New York Stock Exchange. In this region, they're owned by governments mostly. And now there's so much competition, there's so much technology, consolidation is taking place within exchanges that they're forced to demutualize, become for-profit. Exchanges really were not very innovative. If you think sort of 10 years ago and over a 100-year period, there was hardly any innovation that took place on exchanges. What's the newest product that an exchange has offered? You know, in my list of top 10, I would say ETFs, exchange-traded funds. That has been a very successful new product. Now, I would even put DIFC, created in Dubai, as one of the major innovations in sort of the financial sector, what they've set up there. So exchanges were not very innovative until recently. And they became innovative when a lot of competition came in from what was called alternative trading systems. So now there's a lot more transactions taking place outside the exchanges. And IBM might be listed on the New York Stock Exchange, but really a lot of trading in IBM is not taking place on the New York Stock Exchange. And that's causing its own problems, the fragmentation, the high-frequency trading, the dark pools, that's creating its own problems. And we've done a number of events at Georgetown at the center addressing some of those market issues. Facebook IPO has a huge glitch. So there have been a number of glitches on NASDAQ and other exchanges around the world, not just in the US. So a number of issues to address. But today we're going to focus on the region. And it's been very interesting for me, just in a very short time period, while I've been watching the region, some relatively new developments have taken place. Qatar and UAE have become, MSCI is going to call them emerging markets rather than frontier markets. And that makes a huge difference in terms of institutional investors wanting to pour money into the region. I really didn't imagine it would happen so fast, but Abu Dhabi and Dubai are in talks of a merger, very serious talks that are expected to consummate in a merger pretty soon. So a lot is starting to happen in the region, and I think the region is so well poised to become a major financial hub. The challenge is going to be, the issues are going to be, what happens in Saudi Arabia, what happens in Abu Dhabi, what happens in Doha, what happens in Dubai. How does each market create a niche for itself? Who is going to do what? And I think competition is really going to speed up things just by being included in the MSCI emerging markets category. Doha and UAE will start creating a little bit of competition for Saudi Arabia, which still doesn't allow foreign investment directly in stocks. You can own through ETFs and other ways, but not directly. But as Doha and UAE liberalize more, then I'm sure Saudi Arabia will need to move in that direction also. It is the largest market. It is the largest exchange. It is the largest economy, a very, very important economy. So there's just so much going on here. Let me open it up to our panelists and ask you, in your mind, what are the opportunities and what are the challenges? Also discuss a little bit about how is the region diversifying away from oil and gas? That's such an important issue from a long-term sustainability point of view. So Kareem, do you want to start?
Sure. I think the region is doing a great job at diversifying. I think we're going through a new oil boom, but unlike the 70s where they squandered the resources on trophy assets internationally, the governments here are reinvesting heavily in their backyard. So for the first time in Saudi Arabia, if you look at the budget on healthcare education is bigger than the budget on defense. In the UAE, they're investing in alternative energy. They're running the world's biggest renewable program like Masdar, even though they have 200 years of oil left. They're investing in industry and tourism and trade and many other sectors. In fact, if you look at the growth in the UAE, non-oil sector has been growing at 6.8%, while the oil sector growing at 2%. So they're investing much more into non-oil sectors. Today, at least in the UAE, the non-oil sector accounts for 40% of GDP. In 3 years, it's projected it'll be the majority of the GDP. So there's a clear trend to diversify away from oil.
I just want to touch upon some of the comments you made about the region and about Dubai and Abu Dhabi coming together. In my mind, I think there is absolutely no substitute but for the entire region to come together and have one exchange, one currency. And it's so easy to do, a lot easier definitely than what took place in the EU because of the one language, one border actually, if you look at the GCC in particular. Now for that to happen, you need leadership, which I think is lacking at the moment. And you need people to recognize where their strengths and weaknesses lies. I mean, obviously Saudi Arabia is the biggest, so they tend to drive, and it is natural that they take the lead. But being a country that's very much in isolation or restricted in the sense that you can't go in and out of Saudi as freely as you can go in and out of other countries in the GCC, that limits its ability to take a leadership role. Having said that, if you look at the progression of, let's say, the public markets over the last 10 years, you will see that it has come a long way in terms of opening up. Saudi Arabia is by far the largest market in the region and one of the largest in the world. But having said that, it is still 95% retail owned, which means that the information flow that you get from the local market is actually inaccurate because it has a clear lack of institutional players that will definitely change the landscape. But this is changing. I mean, it's changing since we noticed a noticeable change since 2007, 2008, and I think it's on its way to becoming a lot more open than it has over the last couple of years. It also is an artificial market in a way because contrary to the US and Europe, when markets go up, volumes are highest. But when markets go down, there's no volume because if I'm not buying from you and you're not selling to me, there's no market. So there is a need to have market-making ability in the region. And this way, you can see the real flows happening because you're obliged to quote a price when markets are actually heading down.
Yeah, you know, that's always been a huge debate, whether you should have market makers and what role should market makers play. And my own thinking is that when markets are not liquid, you do need some kind of market makers to make the market, exactly like you said, especially when there is nobody on the other side to buy or sell. Yeah. Yeah. In terms of retail participation, is it that low, that high in Dubai and Doha? And
I think it is. It's a general issue in the region. One of the things that contributes to that is that you have large percentages of the companies that are listed not really trading because they're in government hands. Some of the cases they're in private hands, but you'll have the majority of it not trading. You have companies listed in Saudi Arabia where it's a 5% or 10% float, and the rest is in very sticky hands that doesn't trade. So you have these small floats, and there's kind of a chicken and egg problem where the small float enables small volume or small trading sizes, and that attracts retail investors more than institutions. I think the other thing, and by the way, I see all of this as glass very much half full. I see just tons of upside in the development of the financial markets here. These are all of these things that we're talking about, I think, provide tremendous opportunity in the region. The development of institutional investors that are native to the region is also very nascent. Mm-hmm. So you have the large sovereign wealth funds, of course, the surpluses of which, most of which have been directed into external markets. But the development of things like pension funds, where you have pension funds that are investing domestically, that's nascent. The insurance industry is very small. The collective investment schemes, mutual funds and so forth, that's very small. All of that, I think, is going to come. The way I see, the lens I look at the region through is that there's the amount of change that's happened just, you know, in recent years, whether you call it a generation, half a generation, the past 10 or even 5 years, has been tremendous. Socially, economically, structure of economies. And I think that's going to continue, and so these things that we're talking about, these impediments, will get addressed, and the advantages are enormous. We should talk about those too.
Yeah. But John, what role do banks play? How important of a role do banks play in capital markets? I'm thinking of the Germanys of the world, where banks pretty much played a big role. And because of that, you had, in Germany, for example, a much more debt-oriented market rather than the equity market. Really, Frankfurt didn't start developing as an equity market until, I'd say, relatively recently, because the banks played such a big role. Is that some of the problem, in a sense, here? Or?
The corporate financing here is very bank lending dominated. I think you see capital structures being very dominated by bank lending. So the development of bond markets is also in its infancy, like the equity markets. Equity, the large majority of the private sector here is also in the hands of privately owned, very large enterprises, but privately owned. So I saw a statistic, I think it was out of a McKinsey study, that said something like 90% of the non-oil and gas GDP in the GCC states is controlled by these large family, they tend to be conglomerates. In many cases, in most cases, I think, those are first-generation firms, and so that equity is held tightly, but you're starting to go through a generational transfer process as well. And I think that'll also open up liquidity and open up ownership, including additional equity financing.
You know, I was in Turkey a little while ago, and in Turkey, you have the same issue of where families control a lot of the shares, basically, they own. But still, there's quite a bit of liquidity. And the family firms have been very good about adopting very strong corporate governance norms. And I wonder if there's something that can be taken away from Turkey in that respect. It's also a country where they're in the process of demutualizing the Istanbul Stock Exchange. It's going through that process. But Johannes, you have been looking at these markets for a long time with your IMF background. So where does the Gulf region fit in your overall picture?
Sure. I think the best thing would be for me to provide more sort of the economic perspective. Because as you know, finance, in a sense, sort of trails economics from that perspective. And the GCC has been, for the last, I would say, 5 years, probably since sort of the Great Recession, one of the fastest growing regions in the world. Qatar, for example, has had the fastest growth over the last 5 years in the world. And that has led investors from around the world to look more closely at the region. Now, the biggest problem that institutional investors, global institutional investors have is that they don't see really some of the traditional products that allow them to diversify into the regions. I'm thinking, for example, of ETFs. The only case in the region is Saudi Arabia, but even there, sort of volumes are relatively low. And it's not easy to liquidate as fast as global investors would like to do. So we see, for example, a lot of investors coming to us and asking, how do we get, for example, exposure to Qatar? How we get exposure to the UAE? And there isn't really a clear answer yet. I think, as John was saying, there's enormous upside potential, particularly now with Qatar and UAE being part of the MSCI emerging markets. Institutional investors will have to sort of diversify into the region because they hold in their passive portfolio, they hold sort of a percentage in all of the MSCI sort of countries. And we expect, for example, for Qatar, that about $400 million will come in as a result of that. Now, how do they invest? The problem, as John was saying, is that many of the companies that are actually doing very well are either privately owned by sort of first-generation families, or they are state-owned. For example, here in Qatar, you can look at Qatar DR, which is the largest real estate investor, which is not traded. But it has a small window through Barwa, which allows you to invest in some of the sort of activities. You get fantastic returns, but volumes are very low. So this is the challenge going forward. That is, how can this type of, if you like, this form of capitalism, which is partly state-run and partly family-owned, how can that be transformed into the type of shareholders sort of capitalism that we're more used to in sort of Europe and in the US? And I think a lot will depend upon how the exchanges behave, how they develop. A lot will depend on the disclosure requirements, because that's another issue that is very important in the region, which does not yet meet, say, international standards. And another one is also what kind of financial products, what kind of financial innovation can be introduced in order to attract these global investors to the region.
And another piece of that pillar is issuers. You've got to have issuers, and only then there'll be investments. What is the role of privatization? In many countries I've seen, and many emerging markets, where it was privatization that provided a boost to the capital markets, and good experience with privatization, and that led people to come into the markets. Is that likely to happen? And could that be a boost?
I'll take that one. My PhD is in privatization, and Reena sat on my dissertation, so yeah. she asked very hard questions. So the thesis of my PhD was the objectives of privatization and why governments do it. Around the world, governments do it to reduce fiscal indebtedness, reduce government borrowing, stimulate the economy. In the Gulf, we are flush with fiscal surpluses, wealth, liquidity, oil. They do not need to privatize to reduce borrowing, essentially. Now, they could do it to increase stock market participation, like in the UK, but it has been very slow. They have done some public-private partnerships, for example, on the power and water sector, where it's a form of privatization on a BOT, BOO basis, but very few companies have been listed here from the government. For example, in Dubai, everyone's waiting for Emirates Airlines to be privatized, or Dubai, or Jumeirah Group. There are some great assets, but the governments haven't done it yet. And partly because the liquidity is not there, the valuation is not there. For example, they decided to take DP World public in London versus here. The stock markets are not ready to take on the huge IPOs here that will give the governments the valuation liquidity they're looking for. So it's a bit too early.
So it's a chicken and egg sort of a problem where if you don't have the privatizations, the liquidity is going to be a problem. And if liquidity is not there, you don't want to bring your companies to the exchange. And that's where the government has to play the leadership role and say, we'll bite the bullet and do the listing right here. So Kareem, you are, one of your portfolio companies is going public, and you're taking it public on the London Stock Exchange. Obviously, that's a huge transaction, so the markets here won't be able to absorb it. But what do you need as private equity investors? You need to exit, you need to do IPOs. When will you be comfortable with the markets here? What do you need to see happening?
Let me tell you about two transactions, and I'll pass it on to Hussam. DIFC is a new market. The government's promised us a lot of exciting development, number of companies listing and growing, and liquidity coming. So we decided to list one of our portfolio companies 6 years back. And today we're still the only listed company on that exchange, and there's zero liquidity. And as a private equity firm, I'm still sitting on a position. I'm trying to offload it in the secondary market, but every time I sell 1%, the stock price goes down. It wasn't the exit I thought it was. So second time around, I'm a bit wiser, and I'm working with John on taking company public on the London Stock Exchange, where I can sell down 50% at IPO at global valuations. It's a company in oil and gas. So until the governments invest in their stock markets and start listing their crown jewels and creating the liquidity, why should the private sector lead? I mean, we tried, we're willing to accommodate, but really this push should come from the government.
I just want to add to what was just said in terms of the markets in the region opening up. I think with opening up the market, you come under a lot of scrutiny. And certainly the markets here are not well equipped to addressing the audience, the international investors. And for that to happen, obviously you need to have, at the government level, people that understand what it means for those markets to be open. So the tendency is to keep the status quo exactly for what Karim just said, that the market is flushed with liquidity. And you would argue the point that it is at the point where you are at the most powerful in terms of financial adequacy that you actually want to go to the market and open it up, because that's when you need it the least. And it's when you need it the most you get scrutinized. And there was a perfect case in the mid-90s where Moody's came to rate sovereigns in the region. And they started with Saudi, and they actually upset a lot of government officials in Saudi because they said, well, if you don't show us your books, we're going to issue unsolicited ratings. So actually canceled their visas and they sent them back. So that's another thing you need to learn not to do with the Saudis. So from that, you know, a lot of things filtered through, and I think now governments are a lot more relaxed about opening their books, because obviously their books look a lot nicer than they did in the mid-90s. But in terms of markets, IPO is certainly one route. It is actually the most ideal for private equity people like Karim and I, but it's not the only way. And I think as you demonstrate that the private equity model actually does work in the region, it really doesn't matter how you exit. That's my argument. That's number one. Number two, I think the private equity groups that operate within the region, whether they're local or international, I think they need to cooperate a lot more and do club deals so they can actually show that this is a friendlier way for people to raise capital or for people to grow their business. And I think that's the way going forward as markets come together and become a lot more global.
Dr. Aggarwal, I think also there's another incentive or impetus from a socioeconomic perspective that will, should be a force in the direction of developing the region's domestic capital markets. And that is the region, let's talk about the Gulf. The Gulf region has a very young population. And traditionally, and I mean over the last 40 years or something, you know, there was a large baby boom after the first and second oil shocks in the 70s. So you have a very young population as a result of that. And traditionally, most of that population was absorbed into the public sector, going to work for government. But the government capacity, generalizing, and obviously it's different country by country, but generalizing, government capacity to continue to absorb all those youth as they come into the workforce now, and they are coming into the workforce in droves, is running out of road. It's very limited. And so what we see, and this goes back to a point Karim was making earlier, we see governments wanting to diversify their economies. They need to do that, not just out of economic prudence because they want to have less reliance on oil and gas, but also because they need to create private sector employment opportunities for their people. And creating a domestic financial industry in a country is one of those ways. And I think there's a general mindset of, you know, hey, we've got all of the money, financial resources that we do, and the countries in the Gulf, you know, are some of the most liquid, largest budget surplus, largest current account surplus countries in the world. We've got all this financial resources. We should be using this to not only make a financial return, but also to help develop our financial industry as opposed to a financial industry in London or somewhere else. So I think that's something that's kind of a force pushing us in that direction. It's not something that'll be sudden, but it's something that'll be there for a while, pushing us in that direction.
Maybe I can just add to what John is saying. I think all countries in the GCC share that view. But on top of that, there's going to be a lot more pressure, I think, from global investors wanting the same thing, wanting to be part of the, if you like, the growth story of the GCC, wanting to have a share of that, and wanting as a result to sort of have the means to participate in the markets. The one thing, for example, that investors come to us for is to say, well, how can we play a role in the real estate sector, right? Because real estate is the only non-tradable commodity, and you know, if you have large growth, you'll have a large increase in sort of land prices, and they want to be part of that. And of course, the biggest problem is you cannot sort of, at least in Qatar, except for small areas, you cannot actually own land, but you can maybe participate in certain sort of real estate projects. And just listening to the discussion up to now, my sense is that where the growth in sort of equity participation will come is actually into new projects. I'm thinking, for example, of the projects here in Qatar, like the Pearl and UDC. That is one sort of example of how equity participation could actually work, and where a private capital and sort of global capital could participate in some of these large projects in the region.
Yeah, you know, in my own mind, I'm not too concerned about the Emirates and the large firms and profitable firms. They'll be able to, if they need to, they'll be able to raise capital globally anywhere. But I think capital markets are really important for SMEs, small and medium-sized enterprises. They cannot go and raise capital in London or New York or wherever. So if you don't have deep markets, liquid markets, then it's the SMEs that do tend to be the engine of growth that you want them to have access to capital. And from their point of view, it's really important to have the government playing a role in helping capital markets develop. And I agree with you, Hussain, that IPOs is not the only way to exit. And we've seen this trend globally. The number of IPOs is down dramatically around the world. And one of the arguments that will be made is the role of private equity. And private equity doesn't have to exit only via IPOs, but that's a really nice exit to have if the option is available. And in an IPO, as you know very well, you're not exiting right away. It's going to take a number of years. I teach a private equity course at Georgetown, and one of the cases that we do these live cases. So one of the cases we do is Skype. Right? So Skype was owned by eBay, and then Silver Lake, the private equity firm, bought it from eBay because eBay really wasn't able to integrate Skype and take it to the next level. And within 2 years, Silver Lake, the private equity firm, turned Skype around dramatically, filed for an IPO, but along came Microsoft and made an offer. And Silver Lake was more than happy to take Microsoft's offer rather than go through the whole IPO process, in which they wouldn't have been able to exit right away. And it's also an interesting transaction. You might have heard a lot about US corporations holding a lot of cash, the Microsofts and the Googles and the Apples of the world, and pharmaceutical companies. They have tons and tons of cash on their balance sheet. But that cash is not in the US, that cash is sitting overseas. The reason being taxes. If you bring the cash back to the US, you've got to pay the 35% tax rate. And Microsoft was able to pay a higher price for Skype because Skype is a foreign company. So Microsoft could use their cash outside the US to pay for this foreign company, Skype, and pay higher valuations than they could have for a local company. So there are just sort of so many things that go into the equation in terms of how a private equity firm might want to exit. You know, it was interesting. Our let me see if I can find this. Our MBA students, our executive MBA students, they were here a few months ago, and they did a survey of about 300 market participants, and they asked the question, what are the most significant obstacles to growth in the GCC, to economic growth in the GCC? And the issues that were mentioned right at top of the list were foreign ownership laws, whether it's real estate or it's equity ownership. Stock market reform was on top of the list. Lack of bankruptcy laws, that was pretty high up on the list. And lack of educated and skilled labor force was also pretty high up on the list in terms of the local people saying these are the challenges for economic growth and financial growth in the area. And let me ask our panelists, what are the challenges that you see? What are the major ones? And what is being done to address them?
Well, I think the one issue I would raise is definitely foreign ownership makes it problematic to have some types of financial innovations. For example, I'm thinking again of sort of the potential of having ETFs on some of the stock exchanges in Qatar and the UAE. And one of the issues from a regulatory perspective is to make sure that sort of even an ETF does not breach some of these foreign ownership rules, because there has to be an intermediary for the ETF, which is, say, for example, Qatar National Bank or whoever it might be. But that intermediary has to make sure that, you know, that does not sort of in and of itself breach the foreign ownership rules, which could be as low as 25%, or they go up to 50% depending on the industry. So that's one issue that sort of constrains the type of financial products that can be offered to clients. Another issue is definitely the issue of gross settlement. As I was saying before we started this panel, one of the things that we face is the fact that the markets are not sufficiently sophisticated to provide a T+1 gross settlement of transactions. And that puts sort of global investors or shies them away from the market, because they say, how can I liquidate my position and then just wait 3 days before I can get sort of my, get the cash out and invest somewhere else. That makes it very problematic. So I think there has to be definitely an improvement in the sophistications of the markets. It also, there has to be a way in which these foreign ownership rules can, in a way, either be relaxed, which is a political issue, or at least that they don't become a hindrance to some of the financial innovation that is needed.
What type of ETFs are being considered? Just broad index-based?
Yeah, just sort of passive index-based. For example, on the Qatar exchange or the Dubai exchange, there's a very large demand for this. And the interesting part is that the region is also perfectly located from a geographical perspective on the global map, because you know, the Asian market sort of closes when the markets here open, and the markets here open 8 hours before, say, New York opens. So in a sense, they could be a bridge for global investors to do some of the transactions. And cross-listing may actually be one area of growth also over the next...
Cross-listing within the region, or...?
It could be also global cross-listing. You could think of ETFs that are traded in the US that could be listed here, so that you can trade them when New York is closed. And that could be another sort of financial innovation that could bring the global GCC markets, the GCC market into the global finance world.
I was going to add, when you're talking about the challenges, I'd agree with, so the bankruptcy, lack of bankruptcy code you mentioned, also the issue of gross settlement. That's one in the region where you don't have so-called netting laws in countries. But competition, I think, is going to take care of those eventually. Right now we have, you have at least four places in the Gulf competing to be financial centers. You have Dubai, Abu Dhabi, Qatar, and Saudi. And in order to attract business, I think we're already seeing signs of people beginning to address these. For example, Abu Dhabi is putting in place a new free zone, a financial free zone. The law has been passed there, been decreed by the ruler to establish it, and the law specifically makes netting possible. It specifically in the law creates a netting jurisdiction. So, and you'll have you know, the bankruptcy framework that that the DIFC put in place. And recently, the DIFC opened up the DIFC courts, which are based on English law, to anybody who wants to use them. You don't have to have a nexus to the DIFC anymore. So I think competition in the region is going to, over time, help us take care of some of these things.
But I want the two of you to address a little bit the role of sovereign wealth funds. Those are obviously flush with money, and they can do a lot of things in terms of economic development. As private equity, to what extent are you involved with them, and what role are they playing?
I think the sovereign wealth fund role is probably the most misunderstood role in the region and certainly the world. I mean, if you're looking at it from a foreign perspective, it's clear-cut. You're there to take money from them so they can invest outside. But you have to look within. What does the sovereign wealth fund want to achieve? They're just like any investor. They want return on capital. So I don't see the need for them to have any other burden by being socially responsible. That's a choice. But they're there to make money on behalf of the government that they operate in. Now, sovereign wealth funds are really limited to, in a large scale, to 3 countries. There's Qatar, there's UAE, and there's Kuwait. But then you look at Saudi, there is no such thing as a sovereign wealth fund. There is an attempt of a sovereign wealth fund, but at the end of the day, SAMA, or the central bank, manages the reserves of the country, and they just simply do that. So they act as defense more than offense. And sovereign wealth funds, just like any other investor, they make big mistakes. They go into lawsuits. They try to claim money back. So they behave in exactly the same way as all of us do here. So I think the burden placed on sovereign wealth fund is actually misplaced. And I think you need to understand their mentality from within to actually appreciate what they're trying to achieve. Now, in moments of crisis, I can see why people run to sovereign wealth funds to think that they're lenders of last resort. But that's our problem. Their issue is that they may see you desperate, but to them it's an opportunity. So if you bridge this gap, there will be no disappointment in terms of what the role of the sovereign wealth fund is.
We have a lot of experience dealing with sovereign wealth fund, but surprisingly, international sovereign wealth funds. What people don't realize, for example, if you take the Abu Dhabi Investment Authority, it's called the Future Generations Fund. It was set up to diversify away from the UAE, to basically give global exposure. So we're backed by Asian sovereign wealth funds, Europeans and others, and when I go to Singapore or China, etc., I said, why are you coming speaking to us when you have the biggest sovereign wealth fund in the world in Abu Dhabi? I say, because they're not allowed to invest in the local market. We're forced to go abroad. So it's a bit ironic. You're sitting on a lot of surplus and liquidity. If you take Kuwait Investment Authority or QIA, Qatar Investment Authority, or ADIA, they're set up to invest outside of the Gulf. So local private equity firms don't have access to that huge pool of liquidity, essentially.
And you know, that's the idea is diversification.
Yes.
So the reason to require them to invest outside the region is partly for diversifying reasons, right?
Yes.
Earlier, Kareem, I think you mentioned and others mentioned the role of institutional investors. That is critical for market development.
Absolutely.
And so what is it going to take? Pension funds, mutual funds, insurance companies, because they bring a lot more expertise to the market, and the market doesn't get manipulated that easily when you have institutional investors rather than 95% retail investors. What is it going to take to develop institutional investors?
Please go ahead.
Well, one issue, for example, in the region is the fact that pension funds are not actually as well developed as in other parts of the world. And I'm thinking particularly for the expatriate community. Right? Here in Qatar, the expatriate community accounts for almost 90%. But there is no regulated or no requirement to have some kind of pension fund. It's just normally an indemnity at the end of your service here. And so most sort of expatriates who can afford it invest abroad. Now, a requirement for employers and employees to contribute to a pension fund that is regulated here in Qatar would definitely have a larger impact on the equity market, because then sort of at least a portion of these investments would need to be locally based, and that would then provide a big boost. I think in some of the other countries there is some talk of sort of moving in that direction, but there's nothing yet that is sufficiently concrete to provide a boost.
I think part of it is simply time as well, what it will take for pension funds to develop. I won't mention the country, but we have a client, a pension fund for public sector employees who are citizens of that country that until last year just kept its assets in bank deposits. You would never find that in the West, or in other parts of the world. But they just hadn't gotten around yet to addressing that and to putting in place the professional staff and the frameworks and the investment committees and all the things around a pension fund. But they have addressed that in the past and made tremendous progress in a very short period of time, like so many other things in the region. And I just think that's something that'll continue.
Yeah, it's sort of interesting. We kind of forget that everything that's happened in the region, we're literally talking about the last 10 years at the most.
Yeah.
Right? So there's been a lot that has happened in a pretty short time period, and you can't jump 50 years in 5 years.
Although they did it on the real estate side.
That's right. Yeah, I'm looking forward to coming back to Doha in the next few years, and I have a feeling I won't recognize the Doha of today, but in a few years what will be happening.